Welcome to the Deep Dive. Today we're looking at Autodesk's Q1 results for fiscal 26.
That's right. We've got the reports, the press release, the investor deck.
And our job is to, pull out the key stuff. Performance, outlook, the works.
Okay, let's do it. So, headline number, revenue, came in at $1.633 billion.
$1.633 billion. How's that compare?
Pretty strong. That's up 15% year over year, or 16% if you strip out currency effects, constant currency.
Okay, solid top-line growth then. But I saw the GAAP net income figure looked different.
Yeah, that's the standard accounting view. It was $152 million.
Which is down from last year.
Right, down from $252 million. So you've got revenue going up, but reported profit going down.
So what's driving that difference?
Well, that's where the non-GAAP figures come in. They paint a different picture. Non-GAAP earnings per share hit $2.29.
And that was up.
Up 22%, yeah. A healthy increase. The gap is mostly down to a couple of big items. There was a $105 million restructuring charge and also a $54 million non-cash adjustment for stock-based comp. It related to an old ESPP in Australia going way back.
Okay. So specific charges hitting the standard number, but the underlying adjusted profit looks healthier.
Exactly. It gives you a sense of the core operational performance, kind of stripping out those specific items.
Got it. What about other key numbers beyond income? Billings, cash flow.
Billings looked really strong, $1.434 billion. That's a 29% jump year over year.
Wow, 29%. That's a good sign for future revenue, right?
Definitely. Billings are a good leading indicator. And cash flow is healthy, too. Operating cash flow up 14% to $564 million.
And free cash flow?
Same story, $556 million, also up 14%. So good cash generation.
All right, so let's dig into where that $1.6 billion in revenue actually came from.
Yeah.
How do the different business segments do?
Sure. So their main design segment, think AutoCAD, Revit, Inventor, that brought in $1.361 billion.
Okay, the biggest chunk.
Yeah, by far. And that was up 14% or 15% constant currency. Solid growth.
And the others?
The Make segment really stood out. That's their cloud-focused stuff, like Autodesk Build, Fusion.
Right.
That grew 23% to $179 million. Or 24% in constant currency. So really strong momentum there.
That cloud strategy seems to be working then.
It certainly looks like it. Even their other category, things like consulting, was up 22%.
Okay.
Yeah.
What if we slice it by product family, like AECO, manufacturing?
Yeah, good question. The AECO group, that's architecture, engineering, construction, and operations, was the star.
How much growth?
Up 20% year over year, hitting $809 million. Or 21% constant currency, really driving things.
Interesting. Why do you think AECO is so strong right now? Is it infrastructure spending, maybe BIM adoption finally hitting critical mass?
Could be a mix of factors. Definitely seeing continued digital transformation in construction. Even their more traditional AutoCAD and LT products grew 9% to $411 million.
Still growing?
Yep. Manufacturing, or MFG, was up 15%. Media and entertainment, M&E, a bit slower at 7% growth.
Okay, that AECO number is definitely the one that jumps out. Let's look geographically. How did the regions perform?
Pretty good across the board, mostly. America's revenue was $725 million, up 17%.
Right.
EMEA, Europe, Middle East, Africa, also strong. $627 million, up 17%, or 18% constant currency.
And APAC.
A bit slower there. Asia Pacific came in at $281 million. That was up 6% as reported, but 11% in constant currency.
So slower reported growth in APAC. Wonder what's behind that. Regional economics, maybe? Or a slower uptake of the model?
Could be. Something to watch, definitely. Currency obviously plays a role there, too, between the 6% and 11%.
Right. Okay, let's talk about some of those metrics that give us a feel for the business model's health. Margins, retention.
Sure. The non-GAAP operating margin improved 3 percentage points year over year to 37%. Pretty healthy.
Nice improvement.
And customer retention, that NRR metric.
Yeah, net revenue retention rate. It was slightly above 110% in constant currency.
And just remind us, over 100% means? It means your existing customers, on average, are spending more with you than they did the previous year. So it reflects loyalty, upsell, cross-sell. It's a key indicator for subscription businesses. Part of that might be driven by their new transaction model, too.
Okay, good sign.
Yeah.
What about the pipeline? Future contracted revenue, RPO.
Right. Remaining performance obligations, think of it as their total backlog. That hit $7.157 billion.
Wow.
Yeah, up 21% year over year. So a lot of future revenue locked in. The current part of that, expected in the next 12 months, is $4.552 billion, up 16%.
So the near-term pipeline looks solid too.
It does. Now, deferred revenue itself was slightly down, about 1%, but unbilled deferred revenue saw a huge jump.
Unbilled deferred, how's that different?
That's revenue related to contracts, often multi-year deals or early renewals where they haven't actually sent the bill yet. It jumped 67% to $3.228 billion.
67%. Okay, so that suggests strong forward bookings, even if the cash isn't in the door yet for that portion.
Exactly. It points to strong commitment from customers, likely locking in longer deals.
Very interesting. So with all that context, what are they guiding for the rest of fiscal 26?
They're projecting full-year revenue between roughly $6.925 billion and $6.995 billion.
Which is what kind of growth?
That translates to about 13% to 14% growth for the full year.
Okay. And profitability.
Non-GAAP operating margin expected between 36.5% and 37%, and non-GAAP EPS somewhere between $9.50 and $9.73.
And cash flow expectations.
Free cash flow guidance is between $2.1 billion and $2.2 billion for the year. And for Q2 specifically, they're looking at revenue of about $1.72 billion to $1.73 billion.
So continued growth expected, but maybe moderated slightly from Q1's pace.
Seems like it. They did mention factoring in currency headwinds and some caution around the macro environment.
Right. Always have to consider that.
Yeah.
You mentioned those charges earlier, the restructuring and the stock comp adjustment. Any other major items or strategic points from the call?
Yeah, the CEO definitely emphasized their focus on, the big strategic pillars, cloud, platform development, and AI.
Makes sense, especially seeing that make segment growth.
Absolutely. They also talked about optimizing sales and marketing to help margins, and with that strong free cash flow, they're planning to allocate more capital to share buybacks.
Okay. And just circling back one more time on GAAP versus non-GAAP, why do companies emphasize non-GAAP so much?
Well, the argument is that it gives you, the investor or analyst, a clearer view of the sort of underlying, ongoing operational performance. It strips out items that might be seen as one-offs or non-cash, like stock-based comp, amortization from acquisitions, or those restructuring charges.
So it's like a different lens to view the core business through.
Kind of, yeah. GAAP is the standardized rulebook everyone follows. Non-GAAP lets companies present things how they think best reflects operations. But it's crucial, as you know, to look at both and understand exactly what's being excluded and why. AutoDesk provides reconciliations for that.
Always good to check the reconciliation tables.
Definitely. They also noted that nearly 2/3 of their free cash flow for the year is expected in the second half. And they have a target to get stock-based comp below 10% of revenue over time.
Okay, good context. So let's try and wrap this up. What are the main takeaways from this Q1 deep dive?
I'd say overall, it's a picture of pretty strong execution. You've got robust revenue growth, particularly impressive in AECO and that cloud-centric Make segment.
Right.
Billings growth was very strong, cash flow is healthy, and the outlook for the year points to continued solid growth, even with those specific GAAP impacts in Q1.
And looking forward, what are the key things you'll be watching?
Well, definitely how that new transaction model continues to play out across the metrics. Also, keeping an eye on those regional growth differences, especially APAC.
Yeah, that slower growth there.
Exactly. And of course, tracking their progress on the big strategic bets, cloud, platform, and AI will be really important for the longer-term story.
Absolutely. It is fascinating, isn't it? That AECO strength really makes you think, what are the bigger economic currents driving that design and construction software demand? And, maybe more importantly, how sustainable is that surge, especially with all the global economic uncertainty floating around?
Definitely something to ponder. How much is cyclical versus structural shift?
Good question. Well, that's some food for thought. Thanks for joining us on this deep dive.